Hello, ladies and gentlemen. Welcome to the Q2 2022 CFG Market Outlook. Our team's been working hard. We got some good data for you, so let's get right into it. We're going to start with U.S. stocks. This chart is our beautiful, colorful chart that we show every single quarter. We have the S&P 500 in purple. We have the Dow Jones in orange. We have the NASDAQ in blue, and then that lime greeny looking thing is our small companies, the Russell 2000. All U.S. indices were down last quarter. We don't expect a lot of relief in the second quarter or even into the third quarter for that matter. One bright spot, though, was the relative value trade. So higher quality stuff that's a little more cyclical in nature, generally did pretty well over the course of the quarter. So for a lot of the individual stock portfolios we have, especially ones with a little bit of an income tilt, we were already positioned for that. So that is a good thing. We'll just call it happy luck there. The Fed kind of came out swinging. I think a lot of people were kind of in a point where they weren't sure how crazy they were going to go after inflation. But inflation, I think, has made itself as enemy number one, especially on a political front, and the Fed is going to combat it. Which, as a citizen, I think at this point, in terms of feelings and opinions, it's kind of nice to see the Fed actually trying to do something that they're supposed to do. They're supposed to tame inflation, keep it under control. They have a 2% target. It's running at 8%. They got to raise interest rates. So they are currently on pace to raise interest rates 8 or 9 times. At least that's what the market is pricing in at this point, which is contributing to the volatility that we're seeing. On the international front, I was kind of expecting stocks to outperform U.S. stocks. In particular, Europe was starting to look like it was trending in the right direction. Same thing with Southeast Asia. But I think the one thing that we couldn't really plan on or foresee when we were setting our asset allocations and doing our research at the end of last year into the beginning of the first quarter was Russia having a full-scale invasion of Ukraine. The subsequent sanctions are really what is driving the volatility and the downside risk in Europe in particular. A lot of this has to do with their energy policy, some of their trading practices, etc. But in hopes of avoiding the political fallout of my opinion on that whole thing, we will just call it as it is, and Europe is looking yucky. Not a technical term, but I think valid at this point. This chart we're looking at right now is just Europe in and of itself. MSCI Europe Index has not been great this year. It actually started the year pretty darn stable, was outperforming U.S. stocks, and then that big drop we saw was when Russia invaded Ukraine. Sticking with the theme of macro calls gone wrong, I'm always the first one to admit when I got something wrong. Call on China was off in the first quarter. As you can see from this chart right here, their GDP from rate of change perspective was starting to look really solid. We also saw that in their PMI, that's their manufacturing index, was starting to ramp up again. And then all of a sudden somebody caught COVID, tested positive, whatever. They basically just shut the country down, which is why we have this effectively straight down situation going on after Q4 of 21. We're inclined to believe that the economy is going to rebound in the second half of the year, especially as the dollar continues to strengthen. Their exports will become a little bit more attractive in the global supply chain again. Nobody really wants to talk about it, but ultimately cash is king, right? So wherever you can get stuff done for cheaper is where you're going to send your supply chain and your manufacturing. One question that I've been getting a lot recently, specifically on China, is kind of pertains to what's happened with Russia invading Ukraine, and is this whole scenario kind of increasing the odds of China invading Taiwan? In my personal belief and the research that I've done would suggest that the short answer to that question is a definitive no. And I'm just going to leave this here. This is a list of sanctions on Russia so far. This is probably not exhaustive at this point because it seems like something's coming out daily, if not more often in some cases, because all different areas. This in particular is U.S., European Union, Canada, and Australia, and other people participating in sanctions that aren't included on this chart. But I mean, if we kind of look at it, you got to keep scrolling and keep scrolling and keep scrolling. That right there is the reason why China doesn't want to upset the international marketplace, especially because their economy has been struggling and they've taken the COVID policy stance that they have. Ultimately, their goal is shared prosperity. We talked about this in previous videos. And it's really the only thing that's allowing the Communist Party to stay in power rather. Their largest black market trading partner, Russia, is already having issues with their currency. So if it's a scenario where we're crushing the yuan and the ruble is being crushed at the same time, they're effectively trading for worthless currencies because they're not going to be able to work in dollars, which would be a serious problem for China. So I don't think that is a threat in the near term. I could be proved wrong with this, because China has a tendency to surprise all of us on a regular basis. Moving into fixed income, the generally safe investment grade bonds that we normally talk about as being a buffer for portfolios haven't really been a buffer so far this year. A fair percentage of our bond exposure has been resilient, but the 20-year treasury exposure we have in some strategies has been a drag on performance for most of the year. Our thought process was pretty clear from a macro perspective. Generally, when there's a lot of volatility, which we were expecting and we got, most people go to the long end of the curve or to longer dated investment grade sovereign debt. That's just a super fancy way of buying bonds that mature 20 or 30 years from now to hedge out some of the risk that you have in the near term. That has not occurred. Longer dated bonds have definitely gone down in value. Take a look at this chart right here. This is the investment grade U.S. Ag and Global Ag indices, respectively. The U.S. is in purple, global is in gold. I mean, this is not what we're used to seeing in the fixed income market. We've essentially had like a 40-ish, give or take, year bull market in bonds in one way, shape, or form. That has now broken. So not looking great here. One bright spot for strategies that we have is our global bond exposure is actually slightly up on the year. The particular fund that we have used in the past has a currency hedging aspect to it that has borne fruit this year, so that's been helpful. In terms of yield curve, we were dead on with our prediction that the yield curve would invert this year. Just as a reminder, when I say yield curve inversion, it's when shorter dated bonds like a 2-year treasury have a higher interest rate than longer dated bonds like a 10-year treasury. This is not something that happens very often, but generally when it does, it is kind of signaling a possible recession. Just take a quick look at this chart. This gives us an idea of flattening yield curves. The gray area on this chart is every recession that we've had going back to the late 70s. There is certainly a correlation with this here. We had that very quick blip on the radar in the beginning of 2020 with all the panic with COVID, but we are kind of right back where we were on the yield curve back in January, February of 2020. Quick update on U.S. policy. I'm just going to concentrate on inflation because I think most people are kind of in that camp where it's affecting them now. It's finally getting to the point where our food bills at the grocery store are high enough, our gas costs are high enough that people are really thinking about this. And it's not just the lower income people at this point. It's middle income people and even starting to creep into the upper middle class. They're having some issues paying their bills. The administration is essentially pretending to fight inflation right now. A lot of that has to do with the way that they're trying to handle increased gas costs with releasing strategic petroleum reserves, which have to be refilled later in the year or early part of next year by political mandate. They don't really have a choice. They have to buy the barrels of oil back. So that's not doing much for the price of oil. In aggregate, Biden and Congress are generally the ones to blame for this inflationary piece. This chart's all you really need to know. All we have to do is kind of look back over the last 3 years of M2 rather, which is just the money supply in the market. That's the purple line. You can see the initial stimulus that we had during the early onset stages of the COVID pandemic were seemingly necessary given the gold line, which is inflation, signaling major deflationary environments to come. So that stimulus came, stabilized inflation, and then what we're seeing is kind of at the end of 2020 into the beginning of 2021 and the new administration, all of that additional stimulus that went out was unnecessary and actually generated this massive spike in inflation. I'm not going to get into the political aspects of all of this or the why because it doesn't really matter. All we need to know kind of is what do we do to fix it and then where are we going from here? And ultimately that means some higher interest rates, a little bit tighter on the money supply, and we should be in a better inflationary environment here a year or so from now. Now, that doesn't mean we won't have a little bit of pain along the way, but markets don't go up forever, so a little bit of volatility isn't necessarily a bad thing. We kind of stick with the strategy, manage the risk, do the best we can, and then get things reset to a point where we can start climbing and growing again as a country and economy, just here in the United States and then also globally. In terms of general positioning for Q1 and Q2, a lot has been going on. Generally, what we've seen is we kind of indicated we were going to keep low cash levels at the beginning of the year, but then volatility hit big time. So we sold things that were winning and left that in cash to kind of create an additional layer of stability in portfolios. U.S. stock exposure is static right now. We're not changing our overweight, underweight position at all, and it's still concentrated in higher quality, lower volatility stocks. International stock exposure is going to remain roughly the same for where it currently is. While we did get the call wrong, technically, because of the additional volatility in Europe and then also China closing essentially their economy. Again, a lot of that is priced in to those positions at this point. Well, where I don't necessarily see where all of it ends in terms of volatility, most of the bad stuff has been priced in, so it wouldn't make a lot of sense to decrease our exposure at this point. But because there's so much uncertainty, we're not necessarily going to double down or average down those positions either. That goes for emerging markets, like I just alluded to, with China potentially reopening for the fourth or fifth time at this point. We're going to maintain our overweight exposure there, at least for the time being. Fixed income across the board is a relative underweight position, and our exposure still is in non-correlating types of fixed income, much higher at least in those little subsectors of fixed income than we normally are. Commodity exposure is a little bit tricky to navigate because we can't necessarily get direct individual commodity exposure, but the precious metal exposure we took in some of our strategies over the course of the first quarter has borne fruit for us. We realized those gains and left the proceeds from those trades in cash. Now remember, data dictates our positioning, and we very well may change mid-quarter again. That's the beauty of discretion. I can jump in and make changes in portfolios to help manage risk and improve returns over time, smooth out the ups and downs of the portfolio experience. So in closing, I just want to say thank you guys for being clients. Thank you for watching these videos. I'd love to get together and have a review shortly, so please use the link below here or email us at info@cfgfinancialplanning.com. Thanks again for watching this, and remember, hope is not an investment strategy.